All right. Thank you so much for taking some time this evening to learn about one of my favorite topics when it comes to cash value life insurance and business in general. So the topic of this evening's webinar. Okay, so the topic of this evening's webinar will be how law firms fund partner buyouts and retain top talent with life insurance. So why would a law firm do this? Is it so they can just get a big fat life insurance policy on a partner and eventually get that payout when they die? No. While that does have a monetary benefit from a long-term perspective, many times law firms are interested in life insurance for the benefits that come with the cash value. So today, we'll go through exactly how it works and then show you how you can copy a law firm, whether you are a partner at a firm or if you're a partner at a small business, because the concept we're going to cover is applied toward law firms. However, it can be applied toward small businesses and even large corporations. And very quickly, before we get into everything, just to mention, after the webinar, we are going to have a Q&A session. However, this will be only for IBC Global clients. If you're watching this on Zoom, that means you're an IBC Global client. So the information that we are going to cover today is meant for, first, law firms, particularly those with more than just one owner. So there's multiple partners that have an equity stake in the company, or businesses with more than one owner. So we've got multiple partners that have an equity stake in the company. Now, with this strategy, the focus is always long-term. And here's what I mean when I say that. If you have an equity stake in the company, your plan is not just to exit and say, hey, I did my part, see you later. When you're gone, you really want to see that company continue to grow, meaning you care about your employees and you also care about your customers. That's where these strategies and plans work very, very well. So let's start with a question. What does it mean to have equity in a company? Well, it means that you own a percentage of the company. There we go. So, for example, if you own 50% equity in a company, this means that you own half of it. And what that means from a business standpoint and your equity is if the company generates a profit, let's say of $100,000, for example, if your equity share is 50%, that means you get 50% of that $100,000 profit, which would be $50,000. Okay, so here's a question. What happens when an equity partner retires? Well, when a partner retires, it's common for a law firm to buy that equity back from the partner. So here's an example. Let's say a law firm is valued at $10 million. A partner owns a 20% equity in that firm. What's 20% of $10 million? $2 million. When the partner retires, the law firm is going to purchase that 20% equity back from the partner. Now, if the 20% is worth $2 million, that means they're going to pay that partner $2 million. An example might be paying that $2 million over a 10-year period, which would be $200K per year for 10 years, comes out to $2 million. So they give the partner $2 million, and now they have that 20% equity back in the firm. So today's discussion is going to focus on how we can use life insurance to fund an equity partner's buyout. So how does this benefit the partner? How does this benefit the law firm or the small business? We'll focus on those two questions throughout this evening's webinar. Before we get into that, though, a little bit about me. If we haven't met before, nice to meet you. Hello, my name's Steve. That's a picture of me and my lovely wife, Tara. I am the founder and CEO of IBC Global. Our company currently serves about 3,000 clients, many of which have 7-figure, 8-figure, and even 9-figure net worths. And one of our largest clients is a corporate client. It's a bank. And our goal as a company, simply put, is to make the best products and solutions available to everyone. That's both on the corporate level and individual level. Now, before I started IBC Global and learned about this, how I learned about it is I worked at what is called an executive benefits planning firm, where my job was to design policies for corporations. Now, what does that mean? Design a life insurance policy. To simply put it, the firm would work with a company. So let's say a corporation comes to the firm and says, we want to put all of this money into these life insurance policies for our key employees and our executives, but we're very interested in the cash value. So my job was to make sure we had as much cash value up front, as much cash value long-term for that corporation, because the cash value was an asset on their balance sheet. And in doing that, we wanted to make sure that it was set up in a manner so that IRS did not tax it. But it was here where I learned a lot. Firstly, I learned specific details on how to maximize the cash value. I got to learn about corporate benefits, meaning specifically how life insurance products benefit corporations with respect to the product itself, but also a lot more, which we'll get into detail. I got to see how the cash value of a life insurance policy is used to compensate executives. And then the last point, this can apply to you whether you're looking at a policy for a business or for yourself as an individual. What life insurance companies to choose? Let's hit on this point very quickly because there's a million companies out there and it can be difficult to choose. So if you're looking at a whole life insurance policy and cash value is your goal, we always recommend to at least consider one of your 4 major mutual companies. And the reason why is this: proof of performance. These are the only companies we have received and visibly seen proof of performance, meaning not just good-looking numbers on paper. And this is a really big problem in the life insurance industry, meaning if you look at someone who purchases a whole life insurance policy and they say, I'm getting this for the cash value, where buyer's remorse happens the most, where I've seen it happen the most, is when that illustration looks beautiful long-term. I'm going to be a millionaire. But then I only have a fraction of what that illustration projected. That's where buyer's remorse typically occurs. And we've seen that happen the least with these 4 major mutual companies, which are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. A little bit of dividend history. So we can see Mass Mutual's 2024 dividend interest rate, 6.1%. They just declared what their 2025 dividend rate will be. It'll be 6.4% coming up. Then you've got Guardian. You can see their 2024 dividend rate is 5.90%. They have not announced what their 2025 rate will be, but it will likely come up over time. And one thing I want to mention here too, if you're new to this, look down here. So in the late 80s and early 90s, see those very high dividend interest rates? At that point in time, interest rates in the economy were very high. So you'll typically see dividend rates fluctuate with interest rates in the economy. So next, funding partner buyouts. Here's what we're going to cover specifically. First, succession planning. Second, how you can retain top talent. And here we'll focus on non-equity partners, but they could be partners or employees that still have a lot of value to the company. Third, the life insurance benefits. What's the actual benefit of the life insurance and how do firms position this? And then fourth, how you can use the cash value in a life insurance policy as an alternative to working with a bank. And we'll focus on how you can leverage the cash value and use it. So the product that is used for this strategy is a whole life insurance policy. Let's start with an overview of whole life insurance. Whether you're new to it or you've only seen a little bit of it before, if you've had limited exposure, here's how it works. So we've got 3 colors: blue, red, and green. Let's start with blue. That's your death benefit. So the death benefit on a whole life insurance policy will gradually increase over time. And when you die, that death benefit is paid out 100% income tax-free to your beneficiaries. Law firms and companies will typically set this up where they own the policy and they receive the benefit. They're the beneficiary too. Then in red, what do you see? Your premium and PUA rider. PUA stands for paid up additions. We'll provide more detail on both of these terms. For now, this is how we get money into the policy. This is money that we deposit. And then in green, we've got the piece everyone's interested in, the cash value. So the cash value has no risk. It goes nowhere but up over time. I've got guaranteed growth, and I can access it completely tax-free if I do everything right, anytime I want, without any penalties. So no risk, strong guarantees, and I can access it tax-free. So when someone starts to learn about whole life insurance, what question do you think pops up? How do I get as much cash value as possible? And here's what I'll emphasize. When I'm looking at this, whether it's for myself as an individual or a corporate-owned plan, this, in my opinion, is the most important piece. Because if we don't get the product set up right, the process falls apart. People don't have buyer's remorse with the process. They have buyer's remorse with the product. So we're going to hit on what not to do, and then also what to do. We're going to look at a very simple example here. We're going to look at a 40-year-old individual. He's going to pay in $10K per year, and we're going to fund it for 10 years. What we're going to look at, though, is one insurance company and one product. So 10K over 10 years is a total of $100,000. Let's start with an actual life insurance illustration so you can see that we're looking at the same company and the same product. We'll begin with option A. So option A, what do we see here? A lot of columns. Now, toward the top right, you see what is called your premium. That's $10,000. And down here, you'll see that we are going to pay that premium for a period of 10 years, which is a total of $100,000. Now we're going to look at the exact same product, but set up a bit differently. We'll call this option B. Same product with the same company. Here's your premium, less than $1,000. Remember that chart with blue, red, and green? What did red say? Premium and then PUA. With this example, what do you notice? There's your PUA payment, just about $9,000 per year. Add those two together, what do you have? $10,000 per year. So if this is you, you have a product with an insurance company and you pay the same dollar amount every year. But which one gives you more money? Well, when we look at the two side by side, let's look at the first year. Option B has the most money by far. That's $8,700 and change compared to $300. How about year 10? Option B, you've got almost $120,000 compared to about $90,000. How about 20 years down the road? Option B. 30 years? Option B. That gap gets wider over time too. So option B has the most money, but why? Because if this is you, you were just presented a life insurance product where you paid 10 grand per year for 10 years. It was the same product name, same out of pocket to you. Like, what's going on here? Back to that chart in red, premium and PUA rider. Here's how these two work. Premium dollars prioritize life insurance. They eventually build cash value. Whereas money that we dump into the PUA rider prioritizes cash value, and it does get us some life insurance as well. So when we look at option A and option B, both have $10,000 per year going in. But option A has all of it going toward the premium. As a result, there's your cash value. At the end of the 10th year, you don't even have your $100,000 back. Whereas option B, the same company, look at that. Your premium is about $1,000, and look at how much more you have in cash value. So by setting up the policy properly, you can maximize that cash value, which when we position this product for a small business or law firm, that is critical. We want to maximize the value short-term and long-term. And another item to mention here is that you are only billed for the premium piece. Everything in light blue, that PUA rider, that is what maximizes the cash value, but it's also optional. So you can add it at your discretion. This way, you don't feel like you're on the hook for this big bill every year. Make sense? So by minimizing the premium, you're going to minimize the commitment as far as what you are obligated to pay. And then also by minimizing the premium, you're going to maximize the cash value. And on the cash value, we've got what are called 3 core benefits. It's a safe place to put money. You can access it anytime without any penalties at all. And if we follow IRS rules, we can access it tax-free. And it's very easy to follow IRS rules. Most people don't even know what they are, and they don't have to keep track of them. Your agent will typically keep track of them. So that's an overview of the whole life insurance product. So how do we take the benefits that come with the product and fit them into the approach that law firms use and small businesses for that matter? How do they actually use whole life insurance? Let's start with succession planning. Remember this, partner retires and the law firm's going to buy their equity back. We've got the company that's valued at $10 million. The partner's got a 20% equity stake. That's worth $2 million. So they're going to get paid $200K per year for 10 years. Sounds simple. If you're a partner, would you like that? I would. So what's the problem with this? Well, let's pretend for a moment that you join a law firm and you absolutely crush it. Everybody loves you and they say, you know what? We're going to make you an equity partner. You get a 10% equity share in this company. You're like, woohoo, sweet. And that year, the firm generates a profit of $1 million. So what that means is if you're a 10% equity shareholder, you get what? 10% of those profits, which is $100,000. But then you learn, Joe, a retired partner who you've never met, gets $200,000 per year, and that's part of the equity buyback agreement. So now the firm's profits are only $800,000, which means you get 10% of 800 instead of 10% of 100. So now you get $80,000. And this happens for 10 years. And as the profits increase, you feel it more and more. That's a very high-level overview of how this works. But can you see where a problem can occur here with new partners that really work hard? They feel like they're paying for partners that are retired, but they've never met. That's the problem. New equity partners feel like they're paying for a retired partner's buyout. And the reason why is because that's what they're doing, really, when you look at it. What's happening is the firm is purchasing back that former partner's equity, but the former partner is retired. They're not producing revenue, but they're still being paid. And then the new guy or girl sees those profits that he or she would receive, a percentage of those go to that retired partner that they may have never even met. Now, it is a business agreement. It's all disclosed up front, but it can still cause problems. And some people have struggled with it. I remember speaking with a senior partner at a very large law firm, and this is one of the first things he expressed. He goes, Steve, this is just a problem where sometimes young talent will leave because of this. So how can we build a solution? Well, here's a simple version of the solution, which our parents might tell us. Save money now to pay partners in the future, right? Save some money. Here's the problem with that, though. If someone said that to me running a business, I might say in return, you know, I want to use the money that we have right now to continue to grow the business, I don't want to just put money away because I feel like I'm just socking it away for retirement. Like I can do so much more with that right now to keep on growing the company. So this is where life insurance can be an absolute grand slam if we understand how it works and we implement it properly. So what a firm will do with this is fund a whole life insurance policy. That policy is going to build cash value. Now, the cash value in the future is going to be used to buy back some of that or all of that partner's equity, and that's going to be the case instead of using the firm's revenue to do so. What this does is reduce stress on the company's future cash flow. Does that piece make sense? So what we're creating here with the life insurance is really just a savings bucket, and that savings is going to be used to buy back equity or pay retired partners, kind of like a pension. So why would we use whole life insurance for this? I really haven't addressed that yet. Like why this instead of just saving money in the bank? Because the cash value can be used anytime. And when I use it, it keeps compounding. So before that partner retires, if he's going to retire in 20 years, and I want to use the money over the next 20 years, I can do that. And it keeps on compounding for me. So this prevents me from feeling like I'm just putting money away for a future retirement date. Now that compounding piece, we're going to demonstrate this in a little bit. But for now, let's talk about non-equity partners a little bit. So retaining top talent, and let's assume that you've got a non-equity employee that's very, very valuable. Maybe they don't want to be an equity partner. They've got other things going on in their life, but man, like it is hard to replace them. Ever have anyone like that? Definitely possible. So for a moment, pretend that, or think of your most valuable employee. They've got these qualities. They're a hard worker. They're loyal. They're an absolute superstar. A job needs to get done and you are working all night, like they're there to help you out and you always make the deadline. Sound pretty good? Here's my favorite. They don't complain. They're easy to work with. So you have this person working with you. Maybe they've been with you for years. How do you feel if they left the company? You might feel like this. You're going to yank your hair out, right? Maybe you felt like this before. So this is a real problem with law firms and small businesses. How do companies prevent this? Well, one thing you can do is just offer them a huge bonus, we'll call it for now, if they stay with the company. The thing is, this bonus is something they get in the future. But to get this bonus, there's a catch. They've got to meet certain terms. Here are the terms of the agreement. That superstar employee has to stay with your company for the vesting period. Now, the vesting period is a requirement that they have to meet in order to qualify for that benefit, which we're going to call the bonus when they retire. Now, an example of the vesting period could be 10 years. So what that means is if they stay with you for 10 years, they're going to get $1 million. Here's the catch, though. If they leave before that vesting period, they get nothing. So imagine you're told this. If you stay with the company for the next 10 years, I'm going to give you an extra $1 million when you retire. What do you think you'd say? Probably yes. Most people do, and it's why this strategy is commonly used. There's also a phrase in the industry for this. It's referred to as golden handcuffs. As an employee, I might feel like I'm handcuffed to the company because it's hard to walk away from that future benefit. But after I meet the vesting terms, those handcuffs are unlocked and I get to keep them. Then I find out they're solid gold with that white in the middle. We're going to pretend that's diamonds. So they're very valuable. They're worth millions here. This is also referred to as a non-qualified deferred compensation plan. And this is a formal plan, typically with a legal agreement between the employer and the employee. That's how companies often use life insurance to retain top talent. Next, we're going to hit on this point quickly. Some life insurance benefits that are valuable to law firms. Firstly, it provides key man insurance. So if I'm going to take on an equity partner, the chances are extremely high they are extremely valuable to the company. So having a life insurance policy on them provides key man protection, which means if they were to die, we now have money that we can go out and find their replacement, because their replacement is likely going to be expensive. Next, we have what is called cost recovery. So if you own a business with employees, you know that there are a lot of costs that come to running a business and hiring employees. You've got what you pay them, but then you've got health insurance premiums, you've got potential 401k matches, you've got a whole lot of other costs that come with that. And what cost recovery is that the death benefit helps recover all of those costs when that employee eventually dies. So this is typically after they retire. Now, what helps companies a lot is that the death benefit proceeds are paid out 100% income tax-free. Next, an alternative to working with a bank. So we're going to talk about how you can leverage the policy here. So remember this, when I said as a business owner, the idea of putting money into a plan that's just going to satisfy a partner's retirement is a struggle for me. And the reason why is because I want to be able to use that money for my business right now. Remember when we talked about that earlier? Life insurance can provide that retirement benefit for the employee or equity partner in this example, and still give the business access to the cash value. And if I do elect to access it, meaning I want to pull it out and use it for a new location or whatever it might be, it keeps on earning interest. Let's demonstrate this. So how it works is the cash value can be used just like a line of credit. So when you take a loan, your money is going to continuously compound. So for example, if you have $100,000 in cash value and it is earning 5%, that means you get $5,000 that year. If you said, hey, I've got an opportunity over here, but I want to borrow $50,000 against my policy. If the cost to borrow is 5%, that means you would pay $2,500. Here's where it works. You still earn that 5% on the full $100,000, even when the loan is outstanding. Let's look at an example here. A lot of numbers. We're going to go through it slowly. On the left, you've got the illustration where we just let it sit and grow. On the right, we've got an illustration where we take a loan and then we pay it back. Let's start just with the illustration where we let it sit and grow. So here, he funds $100K per year for 10 years. At age 55, his cash value is $1.2 million. His death benefit is $2.5 million. He pays nothing after the 10th year, lets it ride, and by age 64, his cash value is about $1.9 million, and his death benefit is almost $3.2 million. So keep those figures in mind, particularly the numbers that you see up on the screen right now. Have them in mind? All right. Let's look at the same illustration, but with loans. So we take a $1 million loan in this example, and we did it at age 55. You can take it anytime. We just did it at 55 because there's no more payments going in, and it makes the chart a bit easier to follow. There's our outstanding loan balance. Now, when you take that $1 million loan, what is the impact that it has on your cash value? Cash value is worth $220,000, and the death benefit is about $1.5 million. What was it at age 55 if we just let it sit and grow? Another way to ask that question is, what was the impact of the loan? Well, here's a side-by-side comparison. The example where you let it sit and grow, at 55, cash value is 1.2, death benefit is 2.5. You take that $1 million loan, your cash value, which we can refer to as your equity, drops by $100,000, and so does your death benefit. The cash value is the gauge that determines how much you can borrow. Think of it as your equity. If you have a line of credit against your home, that's the equity you have access to. And the death benefit is collateralized dollar for dollar when we borrow against that policy. Okay. What's phase two? What if I pay the loan back? In light blue, we've got your loan payment. Then we see how much is applied toward the loan interest and how much is applied toward the loan principal. So we can pay loans back however we want. In this example, the year we take the $1 million loan, we're only going to pay interest, meaning no principal payments for the first 12 months. So we pay interest only. Then we begin to pay $150,000 per year total toward the loan. We see how much is applied to interest and then how much is applied to the principal. There you go. Then eventually, at the 20th year in this model, the loan's paid off. Okay, fully paid. What's your cash value and death benefit? Age 64, cash value, $1.9 million. Death benefit, $3.2 million. Those numbers look familiar? Might. So what happened to the policy after you paid back that loan? Well, here we go. Side by side, you can see the cash value and death benefit. This might make it a little bit easier. This is just year 20. So in case that text is small, the cash value at age 64 is $1.9 million in both examples. The death benefit in both examples is $3.2 million. It's worth exactly the same. So when you borrow against the cash value of a life insurance policy, you keep earning dividends and interest on your entire cash value, not just what is remaining in equity. So this right here allows law firms to do the following. One, I can save money, and the purpose of that is to buy equity back from partners in the future. But then at the same time, I can use the cash value, the law firm can, like it's my own bank. And I know when I use it, the money will keep on earning interest as if I never touched it in the first place. Now I don't feel like my money's tied up and I'm just purposing it for retirement down the road. Now, the cost in this particular case is the loan interest. And if you're a numbers guy or girl and you're very technical, one of my favorite things to do when we're measuring the cost of the interest and seeing if it's in our best interest is to see what is the cash value growing by each year. Look at that in terms of percentages and dollars. And then right next to it, look at the cost to borrow, the loan interest. Really what I'm doing there is making sure I don't have a negative spread. I want that transparent before I take a loan so I don't have one of those, oh, I didn't know it worked like that moments after I already start, which is never fun. All right, let's talk about how these agreements work. We've got three things or three parties. It's not really three parties. You'll see what I mean. First, we've got the corporation. Then we've got the executive. And then we have the life insurance policy. So let's call the corporation IBC Law. We're going to pretend that we own a law firm, Chelsea. Sound good? All right. So IBC Law gets a life insurance policy on Executive Tom. So IBC Law pays the premium. The policy builds cash value. IBC Law is the owner, so they have access to that cash value. And then they're also going to use the cash value to pay Tom in the future. Next, we've got the life insurance policy. The cash value is an asset on the balance sheet for IBC Law. The cash value is going to be used to pay the executive. And then eventually, when the executive, Tom in this case, dies, the death benefit is paid out income tax-free. And then last, we've got Executive Tom. So he gets the benefit package while he's alive. That can be his buyout in this particular case. When he dies, a death benefit is paid out. But the corporation, or in this example, IBC law firm, gets that income tax-free. Make sense? Let's look at this from both parties' perspective. We'll start with the corporation. So the corporation is going to contribute money. Let's say they contribute $1 million to this company plan. In the plan, we've got life insurance policies. This is going to build cash value. Cash value, again, is a company asset. It's going to compound somewhere between 4 to 5%. And it's also tax-free if we do everything correctly. The corporation gets the death benefit when Tom dies. The corporation creates a vesting period. Say it's 10 years, just to make things simple. Corporation is going to pay Tom his retirement benefit or buy back that equity, but they're going to use the cash value to do so. This is what's used to pay Tom. This way it doesn't come from company revenue. And then if Tom leaves, meaning he doesn't meet the vesting period, he says, I'm out of here. I'm going to start my own company. Well, the corporation keeps that policy on him, which they could just hold it until he dies. They still have access to the cash value, or they can transfer it to someone else. And this is referred to as a transfer of insured. It's not a 1035 exchange. So that's the corporation. Make sense? Let's look at executive Tom. So for Tom, he's got a compensation package that's offered to him. He is told, you're going to get $2 million that will be paid to you over the next 10 years. He agrees to the vesting terms. So he knows he has to stay with the company for this vesting period in order to receive that benefit. So he's going to sign the paperwork, agree to the vesting period. The retirement benefit he receives is $2 million over 10 years. What if he leaves the company before that vesting period, though? He gets nothing. If you were Tom, would it be easy for you to leave? Probably not. So this, again, is what creates those golden handcuffs. Now, if this doesn't make sense, or if you just want to know what to do, we do this for clients. So with that said, I want to talk a little bit about why you would not do this, and then why you would do this, or why companies don't do this, and then why they do. Let's start with why you would not. You've got limited company cash. The profits are limited, small, or maybe they're inconsistent. You don't feel it can help right now, or maybe it makes more sense to work on other employee benefits first. There's times we work with companies, small businesses that say, hey, I really like this. I want to get in and start it right now. And my response is, you can, but I don't know that I would recommend it. I would continue to focus on the company, continue to grow the revenue, grow the profit, and then you can really get a real plan that looks really good. Why would you do this? Or when does it make sense? If I have healthy cash reserves, consistent profits. I like both the short-term and long-term benefits that the cash value provides. I feel that it can help retain and also reward my top employees. And I also see the value of the life insurance benefit. Could be a buy-sell agreement, could be key man insurance, or it could be cost recovery. I really like the idea of recovering all of those costs long-term. A lot of material. Let's look at a sample plan. And this is based on a couple clients we are working with right now. One is a law firm, another is a large financial institution. So the numbers that you're going to see, I will start by saying they can easily be modified. Some companies have looked at these plans where they fund $1,000 per month for employees, and then some look at funding 7 figures per year and aggressively stuff money into the product. The illustrations that we ran do use a product that has a conservative assumption with respect to the growth rate, meaning they could look a lot higher than what you're going to see here. So we've got John, who's 45 years old, and then we've got Gary, who's 50 years old. Let's start with John. So John is 45 years old today. He is going to be due $1 million at age 65. So the law firm is going to fund this plan with $50,000 per year for the next 10 years, which gives them a total of $500,000 as far as what they paid into this policy. The law firm owns it. Okay, here's the policy. Remember that base premium and PUA piece as far as the product? Here you go. There's the minimum premium, $5,000. That's what they're billed for every year. But they plan on adding another $45,000 per year into PUAs. That gives you a total of $50,000 per year for 10 years, which is $500,000. When's your break-even point? Fourth year. If you don't know what that term means, break even. The first year, your cash value is equal to or greater than your total out of pocket. We didn't break even the first 3 years because we have less in cash value than our total payments. Now, if we look at age 65, which is going to be the next page, what do you notice here? Cash value, just over $1 million. So the firm started this plan for John when he was 45 years old. They paid $50K per year for 10 years, to a total of $500,000. After age 55, there were no more payments. They let that cash value ride, and now it's worth more than $1 million. Time for phase 2. So you own the law firm. Now you have to pay John. You're going to buy back that equity, and we'll pretend, for the sake of this example, it's worth $1 million. So that buyout begins at age 65. We're going to buy back $1 million in equity over the next 10 years. We can do it faster or longer if we want. The agreements are typically made up front. So the firm's going to buy back the equity. Let's take a look. We're going to start at age 65 here. There's the annual income. So $100K per year is being paid to John, and it's being paid from the life insurance policy. There's your total income. So in light blue, when does that stop? At $1 million. When you take that $100,000 per year, what happens to the cash value? Goes down. What about the death benefit? Goes down. Summary of what just happened here. The law firm or small business contributed $500,000 to this plan. But then the firm distributed $1 million from the plan. They did that through withdrawals and loans against the life insurance policy. And if we look at age 75, this is the next year after the last payout. The firm still has $300,000 in cash value. That is an asset on their balance sheet, and John is fully paid at this point, but the firm still has the policy on him. We look at age 85, the cash value has now grown to $410,000, and the death benefit is $620,000. You paid $500,000, you pulled out $1 million, and then when he eventually dies, you get another $620,000, and that's also income tax free. See where small businesses and law firms are interested in this from a long-term perspective? It's fun stuff, isn't it? Let's look at our next partner. So we've got Gary. He's a senior partner. He's due $2 million at age 60. So with this one, we're starting later at 50, and we're taking money earlier at 60. We don't have a long runway like we do with John. So the plan here is to fund a policy with $200,000 per year for 10 years, which is a total of $2 million. Let's look at the same thing. There's your minimum premium, $20,000. There's your PUA payment, $180, add the two together. That's what they pay, $200K per year. If life happens and they need to peel back on their payments, they can easily do that, pay the minimum, and they can always make large catch-up payments later too to get back to where they need to be. That is a nice feature to whole life insurance products, depending on the company and how the product is structured with those catch-up payments. But I just throw that in there to say you can do that if a big consistent payment is scary, which I get it, it can be. Break-even point, the fourth year, just like John's. And at age 60, which is year 11 in this example, the cash value is just over $2.5 million. So it's grown, hasn't it? Yeah, it has. So to recap, firm paid $200K per year for 10 years. It's a total of $2 million. At age 60, they stopped the funding altogether. And at 60, the cash value was $2.5 million. Time for phase two. Gary's got to be paid. Their firm's going to buy back his equity. So the buyback starts at age 60. $2 million over 10 years is the agreement. So the firm is saying, hey, we want that equity share back. It's valued at $2 million. So we're going to give you $200K per year for the next 10 years. Here we go. Here we go. So at age 60 is when the income's going to begin. We've got $200,000 per year coming out. The total buyout stops at $2 million when we see it here. So what happens when he takes that $200K per year out? The cash value decreases. How about the death benefit? That also decreases over time. Let's recap what just happened here. The firm contributed $2 million. Okay. How much did they take from the policy? $2 million. So they put in $2 million and then they took out $2 million. Okay. How much do they have at age 70 in cash value? $1.3 million in change. That's a lot of money left over. So what that tells us is if they wanted to fund this product with less, they could do that. But in this case, they've got a lot left over. And at age 85, which is when they're expecting he might kick the bucket and such, so is he, cash value appreciates to 2.8, almost $2.9 million. This is money they've got access to. It's an asset on their balance sheet, and they don't have to worry about taking any more money from it to pay anyone because it's theirs at this point. How about the death benefit? $3.3 million at age 85. Let's look at a different version of this. So here, we're going to assume that the law firm is taking a policy out on Gary, but they've got a large lump sum they want to start with. So here we're going to start with $1 million right out of the gates. Check out the first year cash value. You're about 95% year one. The break-even point is year three. You're close to year two in this example. We also stopped paying into it earlier. After 55, we don't make any further payments. And then look at that cash value ride over time. So with this alternate strategy, we got the money in faster. What this means is we can also take it out faster without sacrificing benefits to the firm. So Gary's a senior partner. He might want to get his payout in a shorter period of time than 10 years. Check this out. We're going to take out income of $400K per year for 5 years. That's a total of $2 million. So he gets the same buyout. And then let's just go to the bottom. Age 85, cash value is $3 million, death benefits 3.5. That's more than the last example we saw with a $200K per year over 10 years. Interesting stuff, isn't it? Definitely. So, now that's a lot of information. Let's hit on some frequently asked questions, shall we? And then we'll wrap things up. So, a question that comes up a lot. How do companies decide how much they want to contribute toward these plans? Well, the long answer to that is a lot goes into it between discussions amongst the partners, the planner, board members, if it's a larger company, but it usually comes down to two options, or two approaches, I should say. First, we have what is called a defined contribution plan, which means you, the business owner or law firm, states how much you'd like to contribute to this plan, and then in exchange, you're told what it provides in benefits. So you're saying, here's how much I want to pay. Versus approach two, we've got what is called a defined benefit plan. So here, you state This is what I'd like to receive in benefits. How much do I need to contribute to attain those benefits? Another way to put it is, I want that car. Tell me how much it costs, as opposed to going into a car dealership and saying, I only want to spend X amount of dollars. That's the difference between those two. Another question, what happens if I get a policy on an employee, but they leave the company? Well, the firm can keep the policy on them. They could also sell it to them. That's a possibility too. But a lot of times what happens is a firm will keep the policy on them. The firm can still access the cash value, and the firm still receives the death benefit. Now, another option is that we can transfer that life insurance policy to that individual's replacement. This is the most common, and it is also very popular among professional ball clubs and sports organizations. Think of it, you have a lot of highly compensated individuals that are very, very talented, whether they're executives or players, and there's a lot of turnover even with those highly compensated individuals. So what companies typically don't want to do is open up new policies, go through new expenses again. If I've got a 10-year-old policy that I could just transfer to someone else and it's already compounding, it's definitely in my best interest. Another question, are contributions tax deductible? Well, the answer to this is almost always no. Plan contributions are not tax deductible, as these are referred to as non-qualified compensation plans. Now, how are the actual benefits taxed? How does it work for the firm and also the partner or the employee? Well, let's assume that a law firm compensates a retired partner $50,000 per year. That payment is tax deductible to the law firm as a compensation expense, but it is taxable to the retired partner as income. Now, if that's confusing, it's the exact same thing as if they were still working for the firm. They're taxed on the income that they receive. But here's an example. This helps me a lot. So again, we'll use IBC Law first. So IBC Law has a life insurance policy with $1 million in cash value. Let's assume that IBC Law, the owner of that policy, takes a disbursement, we'll call it a loan, against that $1 million. The disbursement is $100,000. Is the corporation taxed? No, it's not. This is why cash value life insurance is attractive. So that $100,000 comes out of the life insurance policy, goes into IBC Law's bank account. Now, IBC Law is going to use that $100,000 to compensate the retired employee, $100,000. That is tax deductible to IBC Law as a compensation expense. That also means if I run it through payroll, I'm going to have payroll tax and such on that. Now, the employee gets that $100,000. Are they taxed on that? Yes, they are. I hope that made sense. Who helps with these plans? Our company does help with these, so we can provide plan design, initial setup, and ongoing service. So having a background in this has helped me a lot, both in the corporate side of things and on the individual side of things. But we do help with all of the strategy and initial setup, along with the ongoing servicing of the policy. But these plans are a bit more, there's another layer than what's involved with an individually owned life insurance policy, as there typically are legal agreements. So a legal agreement is drafted and executed typically by a law firm or a third-party administrator. And I will add this too, there are so many sample documents that insurance companies have as well. They're templates of what these agreements look like, where if I'm looking just to understand how it works, we can always look at the samples first. And if we really like what we see, we can provide those samples to our attorney or third-party administrator and just make a few tweaks. Saves lawyers a lot of time, which saves a lot of money, which is nice. All right, that was a lot. I hope it made sense. Here's a few questions before we wrap up. Now that you've learned how you can use whole life insurance specifically for equity partner buyouts, do you see firsthand how it can be used to fund an equity partner buyout? Do you see how cash value life insurance can be used to retain top talent, specifically for non-equity partners? Do you understand the benefits of the death benefit, the value of the death benefit long-term? And then do you see how you can use the cash value instead of working with a bank? Going back to that idea where I can loan against it and it keeps on compounding. So if it's a yes, and you're interested in looking at this type of plan for your law firm or for your company, here's what is typically needed to start. And this is just the very, very basics to begin. Usually a company census just with the participating partners. And a quick side note, we don't need to start with all of the partners at the same time. Because this is a non-qualified plan, we're not subject to rules that we would be subject to with qualified plans like a 401k, where if one person participates, we have to offer it to everyone. We don't have to deal with these typically, again, with non-qualified plans. So a company census, and then just a general description of what you're interested in. And if you said, hey, I'm interested in this, but I'm not really sure what to say to start, that's where we can certainly connect and just provide some guidance based on your company, your circumstances, and what other companies in your position do. We've got a lot of case studies that go into detail on that as well. So if you're interested in learning more or connecting with us, you can certainly click the link in the description if you're on this live. If not, we've got some contact information above. Got my email there as well. And our YouTube channel has some case studies on this as well. So with that said, I just want to say thank you so much to everyone for taking time on a Monday evening to learn all things cash value life insurance and funding equity partner buyouts for law firms. Very exciting stuff, right? It's pretty cool when you see how it works. But thank you very, very much. What we are going to do next is for all IBC Global clients, we're going to transition into the Q&A session. So the live stream will stop here. And again, for everyone that is watching this publicly, thank you so much for your time. We'll see you next time. Let's take a short break. We'll be right back.